Welcome back, Breakaway Wealth. I'm your host, Jim Oliver, and with me today, my co-host, Nick Kosko. Welcome, Nick.
Hey, thanks a bunch for having me. Excited to talk about what we're going to talk about today.
Absolutely. So, one of the things that we hear about, I was on a group call for a real estate investing group community yesterday, and this one participant, he said, "Hey, my brother's been doing infinite banking, and he's not getting any coaching. He's not getting any help. He didn't know what company he was with or anything like that." And I hate to hear that. And obviously, as you know, we've helped some people get straightened out that are in that situation where sometimes you see that they're with the wrong company, a company that doesn't. I mean, again, what's a wrong company? It's really maybe a company that doesn't embrace infinite banking, but maybe it's not even a mutual company. Maybe it's, a stock company. So I thought that, we know that the coaching that we do at CreateTailwind is different because we're actually doing this, right? So we can coach you and we can show you how to build your system because we're doing it and have done it. And some people that get into this, they haven't done it. But when they get into this, they say, Nick, I'm just going to go and see what mutual companies out there have the highest ratings. And is that the best place to start when you're looking for the company? So let's just spend some time today talking about what are the things that we have found. Not that we think, not in theory, but that we have found that doing infinite banking with these companies, really how to choose these companies. Which companies should we work with? Make sense?
Absolutely. It's funny. I was talking with one of our referrals this morning, and one of his first questions was, "Hey, do you do this yourself?" And, it kind of got us into, hey, here's the deal. I do practice. We practice what we preach, and I'm never going to show you a place to put your money that I'm not putting my own money in myself. So I think it does set us apart a little bit, and we do like to talk about that, and we're not shy about sharing our own personal experiences with clients and prospects, and we've done it many times on this show.
Yeah, it'd be kind of like, if I told you, Nick, that there was the best steakhouse that I've ever been to in my life, but I don't actually eat meat, you'd be like, well, how do you know it's the best? How do you know that, right? Yeah. I mean, how could I get excited about infinite banking if I wasn't doing it myself, if it wasn't changing my life and my family's life and for generations? How would I get so excited about it? Well, I guess the honest answer is I wouldn't. I'd be just out there trying to promote something that I wasn't doing myself, that I wasn't trying to build my wealth with, etc. So, all right, let's talk about the first thing everybody wants to talk about when they're choosing a company. First of all, let's just review the difference between a stock company and a mutual company.
Hey, before you go on, Jim, hey, those of you that are new to this, to us, just feel free to go to createtailwind.com. Check out, there's plenty of resources on there. There's a resource tab and a what we do tab. Check that out. And just a little bit of background is, hey, we're Nelson Nash purists through and through. Nelson Nash wrote the book, Becoming Your Own Banker. Everything else you see out there comes from that. And what we're going to talk about here right now is the stuff Nelson talked about in his book. In books, frankly, he wrote 3 of them that are phenomenal on this subject. And what Jim's about ready to dive into here, the difference between a stock company and a mutual company, Nelson brilliantly lays out in his book, Becoming Your Own Banker, which you can find either on Amazon or go to infinitebanking.org and pick yourself up a copy there.
Absolutely. Thanks, Nick. Thanks for that reminder. All right. So there's 2 types of insurance companies, and by law, these insurance companies are required to distribute the profits of the company to the owners. Okay. Seems simple. So
almost like any business, right?
Like any business, right? They are a business. They run the business to make money for the owners. Okay. So a stock company is owned by shareholders, right?
That's right.
And a mutual company is owned by policyholders. So which one would we want if we're going to be a policyholder?
Yeah, I like that mutual one,
Yeah.
and you know what's interesting, a lot of people don't realize this, that particularly a publicly traded company, by law, they have to do things to increase their profits, increase the profits for the shareholder. It's
Right.
very specific how it's worded, for the shareholder.
Yeah. And, you know, there's a lot of stock companies that out there that they push universal life types of products and IULs, index universal life, variable universal life. And there's a reason for that, because they can vary costs and they can, you know, they can project what the policy might do and everything else. And like you said, the whole time lining the pockets of the shareholders, making money for the insurance company, which I'm okay with making money for the insurance company as long as I benefit from that or I own part of the company. Makes
Sure.
sense?
Absolutely.
All right. So let's just assume or agree that we can only use a mutual company or a mutual holding company to do infinite banking. Okay. So what's the next thing we look for? Should we look for ratings?
No, their financials, their financial position.
Yeah. So let's talk about ratings first, though, because people like to do that. It's simple. There's something out there called the Comdex, which is a combination of all the ratings. And they'll say, hey, what's that company's Comdex rating? You know, and there's a couple of companies, and it kind of always varies, like 1 to 3 companies that are 100 Comdex. I think right now it's only 1. And that means you have all of the top ratings across the board. Now, there was a company back in 2008, Nick, that had 100 Comdex. So that means they had the highest ratings.
It was awesome
across the board.
Hall of
right?
Fame, Hall of Fame company, right?
Hall of Fame. They were also the largest insurance company in the United States. They weren't a mutual company, by the way. But in 2008, they had 100% or 100 Comdex, not 100%, 100% of the top ratings. 30 days later, guess what that company was doing?
Almost taking down the world economy.
They were almost insolvent, and we bailed them out. And this was AIG. And as all the taxpayers listening to this, we bailed them out, and they almost were taken down by their derivatives division. Now we could do a whole episode on what a derivative is, but there were 20 people in London, England, that were in their derivatives division, and it almost took down the whole company, right? Now, how did they have 100 Comdex 30 days before they were insolvent?
Did it have something to do with writing checks to places, maybe?
That's right. Those ratings are, I mean, they're for sale. The ratings companies are for profit. So, you know, it just proves that one example, and there are many other examples, that that's not what you want to look at. That the ratings, yeah, they're subjective and they may be influenced by cash. That's the way I would say it. But what would I look at?
Steak dinners, trips, like all that stuff, right? The guy making the ratings.
But what would I look at, Nick, if I wanted to see the financial strength of a company?
Maybe their statutory reserves,
their NIAC ratios. I mean, let's look at their actual financials, right? And so when we look at the financials, we can see, does this company devour their reserves to boost up their dividends in a low dividend environment and lower their guarantees? We can see really the mentality and the management of that company, right? And what we want is high reserves, and we want high statutory reserves, because we want to know that if something really, really went bad in our economy, worse than things that are going on today, would this company be able to survive, pay all of its obligations, et cetera, right? And there are standards out there that the insurance industry puts in place, and we want those we want to exceed those standards, right?
Absolutely.
That way we know we have a strong company. I would say we want to make sure they don't have a derivatives division, but I think that was obvious from the previous story. So, okay. There are some companies out there, major mutual companies, and they don't like infinite banking. Does that mean infinite banking is bad? No.
Not necessarily.
But why don't they like it, Nick?
Well, for one thing is there's a couple of things. One is they want you buying other products. They want you putting, they've got a shtick on how you're going to fund your whole life policy. They want you to direct the dividends to pay your premiums. And then that's part of their sales stick that, hey, you won't have to pay any out of pocket dollars to this policy. And guess what? You can put money in these other products that we're trying to sell you. Right.
So, yeah, one thing we have to remember, especially when we're doing infinite banking, and Nelson talks about this and he writes about it very eloquently, is these are large financial institutions. So what does a financial institution want?
They want control of your money.
And how much of your money do they want?
As much as you'll part with.
How long do they want to keep it?
As long as you'll tolerate it.
And how much do they want to give back to you?
As little as you'll tolerate.
That's right. So, these insurance companies, that's what they want. Now, if they're going to do infinite banking, we're going to take their money and go make money while our money sits with them inside of a tax shelter, right?
Right. So
the company has to like it. Now, why would a company like it? Well, right now, let's say that an insurance company is charging you 5% on a loan, which is 100% secure asset to the insurance company. Is there anywhere else that they can get 5%, 100% secure in today's market?
Not likely.
No. So there are insurance companies that understand that this is a good thing to have people doing infinite banking that are their policyholders. But the majority of people will never take a loan on their life insurance policy. The majority of people will not do infinite banking, and the majority has never been right about anything, as Nelson again pointed out all the time. Right? So we are in the minority. I am okay with that. And in fact, I embrace that. Okay. So these insurance companies that don't like infinite banking, how do we know they don't like infinite banking? Well, Nick talked about Nelson's book, Becoming Your Own Banker, which is really the standard. And that's a book that everybody listening to this, if you have any interest in infinite banking, you got to read that book at least 100 times. No, I'm just kidding. At least a couple of times. And that book lays everything out very, very clearly. Now, there was an insurance company, Northeast large mutual company, okay, that we won't mention. But what they said is that if you hand out that book and you're a career agent with them, okay, you'll be terminated. This is about 3 or 5 years ago, something like that. Now, would I want to buy a policy and do infinite banking with that company and knowing that they would terminate a career agent if they promoted infinite banking with Nelson's book? No, because what's next, Nick?
That's right. That's next. Now they don't support the process of infinite banking. Because remember, infinite banking is not about the product. It's about the process of taking loans, paying them back, rinse and repeat. And in my mind, that sends a signal that, hey, they're not going to tolerate that business for who knows how long, and then support the process of it. And that's one of the things we've seen this before, is when a company changes their tolerance level, how cumbersome it becomes to do the process of banking with an insurance company that doesn't want to service the business anymore.
Absolutely. So, and here's one small example. Is that we have companies that we use that can get you a loan sometimes, no promises, sometimes the same day. Okay. But within 24 hours,
yep,
And so we can move quickly, especially if we're a real estate investor or we simply got caught flat-footed on owing some taxes or something like that. I've seen this stuff happen over and over again over the years. So there are companies out there that take weeks to get a loan. And what they're doing is they're discouraging you from taking loans because they're a financial institution that wants your money. How much? All of it. How long do they want to keep it? Forever. How much do they want to give back to you? None. As little as possible. So remember that over and over again. Okay. So those companies, they're just hard to work with.
Sure.
You know, and so we don't really want those companies either. There are also companies that I think are when you look at illustrations, they're showing you dividends. And by the way, when you see an illustration from any company and the non-guaranteed, the current scale, current dividend scale projection, that will not happen. Okay, just know that will not happen. It's going to be better, it's going to be worse, but it will not be every year that amount. And so the only thing that we can do then that we know for sure is the guarantees. So we want those guarantees have weight. I think more weight than somebody robbing their reserves to prop up their dividend. So guarantees are really, really important.
Yeah, there's very few. I mean, think of it like almost like a risk transfer, right? Like, so if a company is showing, there's no good deals in insurance, right? So where they giveth, they taketh. So if a place is showing you this really high dollar figure in a dividend, well, guess what? It's coming out of the guarantee. So what have they done? They've transferred the risk to you by saying, hey, I'm going to have this cash value here if I get paid the dividend, right? If the company goes, hey, we're not going to pay out these big dividends, but in return, you're going to get this really high guarantee. Well, who just took the risk to perform? Well, the insurance company did. Well, do I want to bet? I kind of think about it. Do I want to bet with or against them? Well, they have actuarial science, the law of large numbers, selection on their side. So these companies we're working with have been around for only over 100 years, right? They've only paid dividends for only over 100 years, right? So they've got a heck of a track record to do this. I'm going to go with them and their guaranteed number. That's what I'm drawn to. So when Jim's talking about, hey, a company is propping up their dividend, just know that guaranteed number is significantly lower, right? And so you're taking some more risk when you approach infinite banking with a platform built like that.
Yeah. The late Norm Baker always said there's no free lunch in insurance. There's either if I take from you in the beginning, I can give to you in the end. If I give to you in the beginning, I have to take from you in the end. And so the key to that is right now, this is really evident, Nick, because there's been a change in the 7702 definition of insurance, and it allows these insurance companies to lower their guarantee from 4% all the way down to as low as 2%. Okay. So what's going to happen is if they don't have to guarantee as much, then they can project higher dividends, right? But right now, until towards the end of the year, with the companies that we use, and really with all the companies out there, you can still buy the higher guarantees on insurance policies. So that's going to change. It doesn't mean infinite banking isn't going to work. It's still going to work. There's lots of things going on. We are in talks and on committees with some of the companies that we like to use. And we are having influence on the design and the manufacturing of those products. And they will still be acceptable. They'll excel in infinite banking policies in cash. Now, part of that is, again, we talked about strength, we talked about access, but let's talk about access in the beginning. Okay, we talked about guarantees. Now, by the way, here's what we like to see in the guarantee, okay, is that after 10 years, the worst thing that could happen is that you have all the money that you put in. Now, think about that. If I go invest in real estate, I go buy a business, I do, is the worst thing that can happen is that I can get all my money back after 10 years? No. And that I was insured the whole time, that God forbid I get hit by a bus, my family gets a bingo.
Is there anywhere, Jim, that you could store your money for 10 years and at the end of the 10 years, you're guaranteed to get all of it back?
Not that I know of. I mean,
wait, what about your friendly bank, Jim?
Well, if I look at how many banks have gone out of business in the last 30 years, Nick, versus how many insurance companies, I'm going with the insurance companies.
Yeah, you're not guaranteed. You are a creditor of that bank when you deposit money in that bank.
That's right. So, all right. So then let's talk about early cash value.
Okay.
Right. Okay. Because there are some people out there falsely teaching infinite banking. When I say falsely, Nelson Nash is the godfather of infinite banking. He is the creator of the concept and the explainer of the concept for the last 30 years or more. Yeah. And he talks about design of policies and everything, and why it makes sense, and that the premium is the solution, not the problem. But then there are some people that don't practice infinite banking to buy assets, etc., because they are teaching it from a scarcity standpoint, and they're concerned about that very first year cash value. And I understand why. Yeah. I mean, it's easy to get into a scarcity mindset, but what we really want is we want to have cash drag that makes sense. Meaning, what am I going to get on the other end? Is if I look at it after 10 years or after 7 years, how's my leveraging looking? Is it getting better and better? Meaning every dollar that goes in, am I having how many more dollars do I have to use? And if it's leveraging, then I want as much money going through there as possible that's leveraging. So some companies, it seems like it could be 3 or 4 or 5 years before every dollar you're putting in is available to use. Okay. A lot of the companies that we use that if you have a woman under 55 years old, maybe even 58 years old, in the second year, you put in $1, you have more than $1 to use. Okay. All of the companies that we use get efficient very quickly. And it's, again, the way that we design it, but that is because it's in the parameters that the company allows us to design it that way. And I'm excited about the 7702 changes, because I think that there are people out there that have term riders on their policies that can drop those.
Yeah.
Potentially.
Well, that's just the thing. Like, when people are manipulating the policy, I always call it like tricking it out. You have to manipulate it with a lot of cost of a term rider. So like, hey, for me to do this, how can I make it the lowest internal cost for you? Right? Like, so am I baking in a lot of term rider costs that is not nearly as flexible as people want to advertise it to be? Right? Like, that's a fool's errand. And we're seeing that a lot. We get confronted with it a lot. There's a lot of very poor information on the interweb about that. Some YouTube channels that are promoting some really false ideas. People haven't done this for very long, and their clients are going to be sorry, I feel, in a few years, when they don't have the flexibility that they thought they were going to have. And that was all for taking the early quote unquote win.
Absolutely. And what we show people is that, let's just look at year 10, because every year after year 10, it only gets better and better and better. Right. So we know that. But in year 10, if I can put in $1 and I have, say, $1.75, well, do I want to put in $1 or do I want to put $1 million and have 1.75?
Yeah.
Right. Because that's where, if I take that 1.75, I go buy cash flowing assets. I bought those cash flowing assets with the discount because I only had to put $1 million in to get the 1.75. So I want my premiums to be as high as possible once my policy starts to leverage. So I want my policy to start to leverage soon, right? But then I want the capacity, I want the volume to be able to flow through there. So we look at all of these different things with these insurance companies, right?
What else, Jim?
I would say underwriting. I mean, we have people that are putting millions of dollars a year in their infinite banking plans, right? And by the way, don't let that scare you. Some of those people that are putting hundreds of thousands of dollars a year in started with smaller policies. Okay.
Right.
Once they understand it, they always expand. They always go bigger. Even if I start at $1 million a year, I'm going to go bigger, right? Because I'm going to have money flowing back to me. So I would say that underwriting is important, and communication with the policyholder, access. I mean, all of those things. So what we do is we're not tied to any one company. We analyze who are the players out there, and if it changes, we add or subtract. And that's why we're here to coach you. And that's really the difference with CreateTailwind is we're going to coach you from the beginning to the end. To the end. The end is when you get hit by a bus, or Nick or I get hit by a bus. What else would you add to that, Nick, before we wrap up?
Well, I just think that you got to look at the flexibility of how you fund the policy, how we can construct the policy with the paid up addition rider. There's companies out there that, hey, if you don't fund that rider, if you don't know what that means, we can schedule a meeting with us. We can explain that to you. But we're trying to fund this rider. It's like a turbocharger for the policy. And I've got a friend here in Kentucky. He's an agent for one of the state-run farm bureaus, and they can only fund the paid up addition rider the first year.
Yeah.
Right. Well, that doesn't necessarily work. Right. So it's understanding the proper way to construct the policy. You'll see some other stuff out there, Jim, not to go down too far the direct and non-direct recognition route, but hey, understand what that is. So when you're looking at an illustration, I mean, there's one out there that's sold by some IBC practitioners that is direct recognition, yet shows a high dividend. Well, we just talked about that, right? So that means you have low guarantees. Well, if you're using the money and you have a direct recognition company, well, guess what? You don't get paid all that dividend when you have that money lent out for your real estate investments, your business investments. So is that really, it's almost false advertising. They're propping up this illustration. You're basically being sold an illustration. That's not the point. Kind of understanding what's under the hood of that. And I feel like we've been fortunate enough to educate some people on that we're being sold some of that here just this year. I can think of a couple clients that were being confronted with that this year. So I think those are kind of the big hitters. We have great relationships with the companies we work with. And just kind of understanding, there's really, Jim, would you say there's only a half a dozen carriers out there that really service this and can host this the proper way?
I think so. I mean, and there are a half a dozen companies that I would say that do it, that aren't captive, meaning if you are going to represent their products, you don't have to only represent their products.
Sure.
Right. And that's, a captive contract. Sure. So we want independence because we work for our clients. We don't work for the insurance company. And they're simply a manufacturer that we have access to their products. And so I would definitely agree with that. The direct versus non-direct, totally agree with that. I think it's misleading when you see, if somebody knows you're going to do infinite banking and they show you a illustration that doesn't show you what's going to happen to your dividend if they're direct recognition when you take a loan. And you know what? You'd be shocked at how many people don't understand direct recognition versus non-direct recognition. That's from experience. That's from people that are pretty sharp people out there that didn't know 5 years ago how that recognition worked. Now, that just means that if those sharp people don't know how it works, these guys that are good YouTube marketers that haven't done this very long, they really don't know how it works because they haven't experienced it. And, you know, I'm going to wrap it up with this, Nick, is if we could develop a plan where, and we can do it one of two ways, Nick, where failure is or isn't an option. Which way would you prefer?
I like it when failure is not an option.
So that's exactly right. And that's the way that we design it, where failure is not an option. You will succeed. You will build this. Okay, Nick, because some people really wait for this question. So I'm going to put you on the spot today. Is if you could only retain the knowledge from one book that you've read, what book would it be?
On all subjects?
Sure, on all subjects.
I'm going to go with the Bible.
Oh, I knew that you were going to do that. And I meant to say other than the Bible.
Yeah, there you go. No, I really, it's Nelson Nash's book, Becoming Your Own Banker. Frankly, it's changed my life. There's a couple close seconds in there, but they all tend to intertwine with each other. But I've talked about that book a couple times this morning with some prospective clients that have come to us via referral. And I can't say enough about the depth of that book and just how simple of a read it is. Go to infinitebanking.org, get a copy of that. I mean, it's what, $20 or something like that. It's the cheapest $20 you'll ever spend. Frankly, you get a lot more back in value than you're going to pay in money. You go to CreateTailwind.com. You know, if you got questions about what we talked about today, need some clarity on anything, just go to contact us. One of us will reach out to you, schedule a 20-minute call if that's what you need, or a video session with us. We are not the hard used car salesman closers. You know, we just love to educate until you decide whether this is for you or not for you. But it's important to be an educated buyer, basically informed consent. Is how
Absolutely. Absolutely. And, you know, infinite banking is a great tool to use to break away from the herd. So, Nick, until next time, thank you very much for being on. Audience, thank you for listening. Feel free to review and subscribe to our podcast. We would love that, and rate us 5 stars or whatever. Is that the most, Nick?
It's the only appropriate amount.
It's the only appropriate. I wasn't sure if they were 10 stars. No, just maybe there was a different category, but just kidding. All right. Until next time, nothing good happens in the herd. So let's break away.
All right. Take care. Thank you.
Take care.